Okay, so here we're going to talk about ORB, Open Range Breakout. And it's a strategy depicted here in this picture. I gave an example. So as you can see, you're trying to gauge the opening high and opening low within 15 minutes of the market open, or you can even do the first 30 minutes of the market open. And then once you draw your levels, the open range low and the open range high after the market opens, you can draw your levels, and then you can see after that where the candles are going to go. If they break above your high level, you know that the stock is bullish and will continue to move high. So you can assume that the object in motion stays in motion until abruptly stops. So if anything is running up high, I'm going to assume it's going to keep running, until told otherwise. Same thing. If these candles would have broke downward, and I would have entered a put position. The whole goal of trading this open range strategy is so that I can gauge whether or not it's worth it to even get into this stock within the first 15 minutes or 30 minutes. And if it's not worth it, then I'm moving on to the next one, and I'm drawing other levels. So just to give you an example of what I'm talking about, this in this blue area right here is the pre-market, after-market hours. So let me make sure that I'm on the New York time. That's what I am. So once the market opens, this is the first 5 minutes of the candles. And when I'm drawing my levels of the open range breakout, I like to do it on the 5-minute time frame. That way I can see multiple candles and I can draw the levels. So I'm gonna let this run for 15 minutes. And then I'm gonna draw my level. So let's just move over here. So let's just act like the market just opened. And this is the first 5 minutes over here, okay? So I let the first 5 minutes run, and then another candle forms, and it looks very bearish. The price goes all the way down here. It comes all the way up here. It ends up closing down here around 187. Okay, that's 10 minutes went by. Now, on the third candle is green. So as it's forming and developing its green candle or whatever the bears and bulls want to do, you see that the price at some point went down over here to 186.50. It came all the way back up and ended up closing here at 87.41. So you can see the price pushed right back up again. So it's more like a sell-off here, and then the bulls are buying back up. So once these 15-minute levels are drawn, I will go ahead and mark the high that it's gotten, which is right here. So that's the high. And then I will mark the low, which is way down here as a low. So that's the highest and lowest point within these 15-minute candles. So there you have it. Now, all you got to do is wait until these candles, price moves above this high point here, and I'll reference it, and I'll say high. And you always got to label your stuff too. So I like to do a lot of labeling. Here. And this is the low, okay? All right, and if the price breaks up high, I'm entering a call. If the price breaks up low, I'm entering a put. So let's see how these candles develop. All right, so the next candle on creating 20 minutes is starting up. At some point, the price broke up here, and it came back down again. So that's 5 minutes. Actually enter in a call position here. And then you can see right now we entered this call position because this candle at some point broke up this high. So you can safely say like, hey, it looks like it's going to be bullish. I'm entering in this candle. So this is the entry candle. And this is you managing your position. And you're doing this live on here as these candles are moving. Because ultimately, this is your money. So you're going to watch your money and make sure no one takes it from you, right? And that's what institutional investors are trying to do. They're trying to take us retailers' money. So you get bullish, up, bearish here, up. Now it drops below. But you don't panic because your stop loss is going to be where? At this point down here below. Because if it drops below here, then you have to enter in a put position. So yeah, you'll lose a little, but you'll minimize your losses by setting yourself a stop loss here at 86.28. So, and that's a whole, $1.50. So anyways, we're going to watch it, see what happens. And you got to study these candles too, because each candle actually tells a story. You know, a red candle signifies that it's bearish and it's moving down. The green signifies moving up. This top wicks signifies that the bears are pushing the price back down. The bottom wick signifies that the bulls are pushing the price back up. So each candle tells a story. Then you have this cross candle, which is a trend change candle. So even though it was downtrending here, it shows that there wasn't a lot of volume within this candle, but it was enough to turn it green. Then you have a greenish candle here. So you're just letting it develop. And as you can see, you're still in this position. And this is what we try to say, is that just because you enter a position here doesn't mean it's going to keep going up. Candles don't move in horizontal fashion and vertical fashion. They move in waves. And this is to show you how they move. Candles move like this. Right there. And that's called the Elliott wave theory. So you're never going to get candles that are going to go parabolic always. So now we entered in down here. And even though we had some bearish movement, we gained, bulls regained momentum. And now they're headed back up. See? Got a little bit of fight going on, a little bit of selling off. But as you can see, overall, you enter this first candle on the breakout above the high. So you're just watching it move up, 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 and you're still making money, you know. But of course, contracts value rises and drops based on when the candles are rising and dropping. As the candles move up, your contract moves more valuable. That's why I try to tell people in chat, sell your positions into strength. Because once you start selling when it's on the way down, it's not going to be worth anything because no one knows if it's going to come back up again. So as you're moving, you can see that the candles are kind of moving along now. Even though this was like a resistance, it's starting to turn support. See, there's a bounce here. There's a drop below, regained, bounce here, bounce here. So now you notice that the candles have taken this resistance and they've made it a true support. And the candles keep going up, 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 up. You kept rising, see? And you're making money all day long off this particular strategy. And then this is the close. So then you can decide if you're a day trader, you know, you're going to go ahead and sell your position at the end of the day. Or at any point during the daytime, if you had to go to a meeting or school, class, you know, take care of the kids, you're busy, you could sell. But you got into a position way over here. So let's see how much money we made. Say you lasted all the way to the end and it closed here and you sold within this candle. And you could have made anywhere like 1% to 1.2% stock price move here. And it peaked all the way up at 1.25% here on this particular stock. So this right here is a perfect example of open range breakout. Now, it won't always be this easy. You know, there's other stocks out here where it might do something similar. So let's look at, say, Tesla and what it did. All right. So this is what happened on Friday. Okay. So same thing. You're going to start off here at the 5-minute candle. You'll notice that out the gate, this thing was bullish. Everybody was making moves, but you want to wait because you never know what's going to happen. Oh, got a nice green bullish candle. We're going to wait. All right. This candle closed red. So now it's working on its fourth candle. But in the meantime, within this fourth candle, we're already drawing our highs. Let me turn off this magnet here. We're already drawing our low down here. So this is the range, high and low. So high, low. All right, now you can just wait, and you can even set alerts. So whatever platform you're using, you can set alerts here. So I would set alerts. Add alert on Tesla. So now anytime this is breaking up, I'm gonna get alert that Tesla's crossing up 454.02. And I know that when that signal comes, boom, I'm entering position. And also I'm setting alert down here. So that if the candles break below here, Tesla's crossing down 436.96, and I saved that. So now we're gonna move and see what happens. As the candles are moving, they're just see if we get any kind of action. See, it's just moving sideways. Like nothing's really happening here with Tesla. Do you really want to be in a position in options when a stock is moving sideways? You don't. You don't want to be in it at all. You want volatility. You want action. So you want breakdowns. That's what you want. You don't want something moving sideways like this. There's not nothing really going on. See, and then it closes. So in this particular position with Tesla, I would never even have entered. We got no real good price action here. Okay. Let's look up another one. Apple. Apple's been extremely volatile. See if we get any action here. And we'll switch it up. Say you don't have to do the 15-minute ORB. You can do the 30-minute ORB. So you can wait 30 minutes and mark your level. So it's 5, 10, 15, 20, 25, 30. So after 30 minutes have gone by, we're on the 35th minute candle. So now we can draw our lows. We can draw our highs here. And then we can see if any action happens throughout. See, if you notice that this was previous resistance here, this stock, Apple, moved all the way back up to the same resistance and came back down again. So there wasn't really no movements. Now, with that said, one strategy that I just talked about was buying calls on the breakup of the high, buying puts on the breakup on the low. But there's another strategy when it comes to this open range breakouts. Now that you drew the levels, you can trade within the range now. So once this comes up to this, and if it doesn't break and starts headed back down, you can enter in a put. If this candles fall down here and bounce back up, you can enter in the call. So if we were to move up, you would see this candle, and right here we'll be watching it. But okay, what's going to happen? It's going to break up. Then the next candle is a nice red candle, so it looks like it's going to be a reversal. So you're looking at enter puts here if it doesn't break above. Trend change. There's another bearish red candle. So these two candles are below the candle. So at any point, you can go say, hey, I'm going to enter in a put here. This rejected off the resistance. It doesn't want to move higher. So if it doesn't want to move higher, what's it going to do? Move sideways or move lower. So if you want to take the chance, you can enter a put entry. Let's see where this goes. I mean, after all, what we're doing right now is gambling. It's calculated gambling, calculated investing. We're not just blindly doing it. This is technical analysis that we're doing. So we entered a put. Oh, we're looking good. We'll blow this up a little more. We're looking good. Is it going down? It looked like it. Oh, it's going down. Still going down. It's reversing. Came up a little bit. Now remember, candles don't move up and down, right? They move in waves. So you get this up and down motion. Oh, then you got a nice drop down here to end the day. So had you entered that put there, based on the levels you drawn back 15 minutes at the beginning, this is your second strategy you're using to see how much money would have made. Say we entered this candle and we sold at the end of the day, we would have made almost 1% stock price on there. So depending on how many contracts you would have bought, you would have made a few $100s. So that's another strategy as far as ORB, open range breakout.